Hello, greetings, and welcome to Dividend Blasters. This is our 56th video, and the topic today, strategic dividend investing, how you can optimize your strategy in your investment selection so you can receive monthly dividend payments across your portfolio. A quick disclaimer, I'm not your financial advisor. The purpose of this video is for information and education. It reflects my own personal opinions, research, and my experience as an independent investor for more than 30 years. So please do your own research and consult a financial advisor prior to making any major financial investment decisions. So let's be a little bit more specific. The purpose is to show you how you can optimize your strategy and your dividend investing approach across your portfolio. I'm going to show you how to select the very best dividend growth stocks. That's right, I'm looking at stocks. I didn't look at ETFs today, just stocks. And I love ETFs. I'm just looking at stocks. I'm also going to show you that as you select these, you're going to get a good, effective diversification strategy in place across each of the 11 market sectors. And finally, I'm also going to show you that you can make these selections, and each of these will ultimately deliver together dividend payments each and every month across the calendar year. So you will not go through a month without a dividend payment. So, how did I do this? Well, I looked at the leading dividend stocks in each of the 11 market sectors. And my approach was to select the very best ones. Now, I didn't look at non-dividend stocks, and I have a lot of non-dividend stocks. I'm looking at dividend paying stocks. And how did I evaluate these? I looked at what their dividend yield is. I also looked at their dividend growth rate. So I wanted to see a decent dividend yield. I also want to see a growing dividend. I also want to make sure that this is a company, or these are companies that are committed to paying a growing dividend. How do I do that? I look at the dividend growth streak. If they've been keeping this up for 5, 6, 7, 8 years, 10 years, that's what I'm looking for. I'm also looking to see if they are safe. So when I say safe, I want to see that there is no chance of the dividend ever being cut. How am I doing that? I'm looking to see a reasonable dividend payout ratio. That's what I'm looking for. I want to make sure that they are not overcommitting and all of a sudden they can't sustain it. And then I'm bringing my understanding of the intangibles here. What am I reading? What am I hearing on the Fox Business News or on CNBC? Or what am I reading on social media? Or what are my friends and colleagues telling me? Is this company doing well or are they struggling? How are their debt levels? Are they able to maintain and service their debt? Are they having issues with cash flow? Are they growing? That's what I'm looking for. I want to know that the company is on the move. Okay. I am also looking at the timing of the dividend payments, and I'm looking at these holistically. So as I look at all these investments, I want to make sure that I am seeing across all of these investments a dividend payment coming out each and every month from one or more of these selections. I selected 1 to 2, and in some cases, I selected 3 per market sector. One of the market sectors, I didn't select one, and I'm going to get to that shortly. And again, I did not look at ETFs. Now, I will tell you this, I do invest a lot in stocks. I also invest in ETFs. I have several shares of SCHD, I have several shares of VOO, and I also have several shares of QQQ. Okay, I do all of those things. I also am a gold and silver stacker. I also own Bitcoin. So I'm probably getting some chuckles out there. What are you doing? Well, that's what I do. Anyway, that's a different video. So no ETFs, just stocks. Here we go. So let's get to those selections. Okay, the first market sector, communication services. I made no selection. And I will tell you that even though I have I love Google, but they don't pay a dividend. I can't select them. There's a telecom company that I was on the fence of selecting. I actually decided not to select it. I used to own it. I'm going to get to that later. So let's press on. But no selection for this one sector. Now I selected for all the other sectors. So okay, next one, consumer discretionary. I selected Lowe's. Okay, the home improvement store. I like Lowe's on an annual basis. They pay $4.40 dividend. It's a quarterly dividend. You can see the timing in the February, May, August, November months. That comes to about 1.9% dividend yield. But I really, really love that 5-year dividend growth rate, almost 20%. That is actually amazing. A lot of investments don't come anywhere near that. We typically like to see uh, at the aggregate level 10% between the dividend yield and the dividend growth rate. Here, you're over 20%. And this shows me and should demonstrate to you that Lowe's is committed to paying its shareholders a growing dividend. And they're doing it easily because that payout ratio is 31%. So there's no problem there. Their earnings are sufficient enough to pay that growing dividend. And that dividend growth streak, goodness gracious, 59 years. This is a dividend king. Absolutely amazing. They got it easily. And I like their total return, 131% over the last 5 years. If you look at the last 10 years or the max time frame, I'm getting this from Seeking Alpha, 30 years, you're going to see huge total returns. But I just decided to look at 5 years. And total returns are price appreciation and dividends. That's why I'm looking at total returns, not just price appreciation. Let's go to the next one. Costco. Well, how can you choose Lowe's and not choose Costco? They kind of go together. Um, they have a modest dividend yield, 0.75%. That comes to about $4 a share, four and some change. But I like that 5-year dividend growth rate of 13.15%. That gets you to almost 14% total. They have been doing it for 18 consecutive years. Again, they're committed to paying a growing dividend to their shareholder. It's a safe dividend. Payout ratio less than 28%. Stock's a little pricey. And if you can't buy one full share, there are several trading platforms like Schwab, for instance, and others. You can buy fractional shares. But if you can buy whole shares, buy it. Buy them. And you can see that these are in the March, June, September, and December months. And I'll tell you that a lot of these that I'm sharing with you pay out in March, June, September, and December. But I do have others so that no month will be without a dividend. And the total return for the last 5 years, 148%. Not too shabby. All right, so that's consumer staples. Let's go to the next one. Energy. You know what? There's a lot of energy stocks that are very good to select. And you know what? I've owned several of them. This one I like the most. I like ConocoPhillips. I like it because of the price. I like it because of the yield, and I love that 5-year CAGR. It is a healthy dividend yield of 3.8%, but the 5-year CAGR, 12.75%, is amazing. It's going to get you to about 16% total, which kills the 10% threshold that we like to look at. Payout ratio, 51%. It is a safe dividend. The current streak is only 2 years. They had a blip during COVID, but they have a long, long history of paying dividends and growing dividends. It's not too pricey, $119 a share last 5 years, 98% total return. ConocoPhillips. All right, let's go to the next market sector. Next one is financials, and I made two selections. So I selected JP Morgan Chase, the mega bank, largest bank in the United States, and I chose Visa, the credit card / payment technology services provider. Both are really good dividend investments. Let me talk about Visa first. They have a very modest yield, less than 0.75%, but that 5-year dividend growth rate, just a bit under 17%, makes it a beast. And you know what? I love that payout ratio, 21.5%. They've been increasing for 14 consecutive years. They're doing it easily. JP Morgan Chase, they have a higher dividend yield, and they have also a wonderful 5-year dividend growth rate of 12.3%, safe payout ratio, 8 consecutive years. Total return, little under 50% for JP Morgan Chase, little under 75% for Visa. You might say, hey, why not just put it all into Visa? Well, you know what? We're diversifying. Okay. And these past total returns are no prediction of future returns, but this is what we use. And I will tell you, I believe that these are outstanding investments. I have several shares of Visa. I have shares of JP Morgan Chase. I am looking to build them back up. All right. And you know what? I also like the spread. Okay. You can see that JP Morgan Chase is January, April, July, and October. Visa is March, June, September, and December. So you have a nice spread. Next market sector is healthcare. I chose the health insurance company United Healthcare. Uh, Not a bad dividend yield. It's 1.5%, but it's the 5-year dividend growth rate, which is truly eye-catching, 16.74%. That is a very safe payout ratio of 29%. They've been increasing for 13 consecutive years. This is not a cheap stock, $476 per share. If you have to buy in fractionally, I mentioned at least the one trading platform that allows fractional purchases. Not all of them do, but that one does, and there are others. It's in the March, June, September, December timeframe, and you can see the dollar amount in each of those months. Little under 91% total return for the last 5 years. Next market sector, industrials. I chose 3. Why did I choose 3? Well, I chose 3 for a very good reason. I chose Lockheed Martin, the defense contractor. I chose United Parcel Service, or UPS, the delivery company. And I also chose ADP, Automatic Data Processing, and they are the payroll services, HR services provider. A lot of companies outsource that function too. I got to tell you, I am attracted immediately to those 5-year dividend growth rates. ADP 13.71%. That is amazing. UPS 12.38%. Lockheed Martin under 9%. They're all phenomenal. They also have decent dividend yields. Lockheed Martin 2.65%. That's not bad. UPS 3.77%. That's amazing. And ADP a little bit more on the modest side, 1.96%. But it's really that 5-year dividend growth rate. These are all safe dividends. They're in the 40s and the 50s. I do like the streak. I really, really like ADP's streak of 24 years. I like Lockheed Martin's streak of 20 years. UPS is very good. They're halfway there towards becoming a dividend aristocrat. They're all going to be dividend aristocrats. The intangibles, Lockheed Martin is a premier defense contractor. They're building the weapons to help keep us safe. We live in a dangerous world, and I will just leave it at that. You read the newspapers, you know what's going on geopolitically in the world. It's an important investment. It's helping to safeguard our country, and they pay a great dividend. UPS, you know what? More and more, as we're more and more connected to each other and to commerce through the internet, we're buying stuff online. And we need somebody to deliver this, and it's UPS. Either it's UPS or it's FedEx or it's the post office. UPS is a massive company. Market cap, they're about 3 times the size of UPS. I don't remember the last time I actually left the house and did not see a brown truck delivering in my neighborhood or around the city. They are everywhere, and they're going to become more and more in demand. I will say this: you've been probably hearing in the news about some of the challenges that UPS has had recently over the last few weeks with the Teamsters Union and collective bargaining. I don't think it matters. Okay, they struck a deal; it's done. This is a very, very successful company. You can see they've actually if you look at the price, they've been coming down a little bit, but we invest in dividends. This is a company that is going to be around for decades, and they're everywhere, not just in the United States. If you've gone around to Europe, as have I see them there. I see them in Great Britain. I see them in the United Kingdom. I see them in Italy. I see them in France. It's really quite amazing to be an American and to go overseas and see UPS, in Europe. ADP, more and more companies are adhering to the law of competitive advantage and comparative advantage. They're focusing on what they do best and they're farming out what they don't do well, like human resource services and payroll services. This is where ADP comes in. So, in sum, as far as the intangibles, the business is good for all three of these, which is why I chose them. You can look at the spread of the dividend payments each and every month. Each and every month is covered by these three. They all have really, really decent positive returns over the last 5 years. Lockheed Martin, UPS around 60%, ADP around 96%, all growing. And if you look at the 10-year and the max time horizons, you can see much, much bigger numbers. But I just focused on 5 years because I want to keep it close and proximate. Let's go to the next market sector. Okay. Materials. Well, Air Products and Chemicals and Lyondell Basel. Okay, both chemical companies, and I chose them both because these are growing companies. I really like the 5 year growth rate on APD, and I like the yield on Lyondell Basel. They're both good. And you know what? Look at that growth streak of APD, 40 years. Lyondell Basel, 9 years. Not bad. Both good, both in different cycles. So you will get, at least from the materials market sector, a dividend 9 of the 12 months of the year, 8 of the 12 months. Okay. Both very good total returns. Lyondell Basel around 25%, APD last 5 years over 100%. So anyway, let's go to the next one. Real estate. I just chose one. I chose the monthly dividend company, Realty Income. We've all heard of Realty Income. They are a dividend aristocrat. The $3.07 annual dividend comes to about 26 cents a month. It's a very reasonable price of $56. Many people think it's a buy right now. Last 5 years, they've delivered around 24% total return. This is a very safe dividend. Let's go to the next one. Technology. I will tell you this was probably the most difficult sector to select one investment. So I selected two. And in my judgment, the two best are Microsoft and Broadcom, the chip maker. The dividend yields are on the lower side, more so for Microsoft, but where both of them make up is that 5 year dividend growth rate. Microsoft 10%, Broadcom 23%, which is absolutely astounding. You usually will not find a technology company that pays a growing dividend. And in fact, a lot of them do not even pay dividends. So it's quite amazing that Broadcom and Microsoft can pay growing dividends. These are safe dividend investments. Microsoft 27% payout ratio, Broadcom 44%. They've been at it for many, many years of increasing dividends. Microsoft 18 consecutive years, Broadcom 12 consecutive years. They both come out, or they both pay in the March, June, September, and December timeframe, but I think it's fine. I think these are growing investments. And if you can go ahead and nibble your way in, especially with, these are both not cheap, but just kind of get a toehold in and start to build your holdings, you'll do very, very well over a longer time horizon. And you can see the total returns. Microsoft for the last 5 years, about 218%. Broadcom, 373%. And Broadcom, a lot of it has happened this year. They have been on a tear. Let's go to the next one. And this is the last market sector we're covering. It is the 11th market sector. It's the utility sector. It's Next Era Energy. The reason why I chose Next Era Energy, they're a little bit different than other utility companies. They have a healthy dividend yield, like a lot of them do. But what sets them apart is they have a growing dividend of 11%. Typically, you'll find some of the older utilities that pay dividends and have been paying them for 50 years. They have a high dividend yield and a minuscule growth rate. They just keep it alive to maintain their dividend aristocrat or dividend king status. But they're struggling to maintain it. And at some point, they may run out. That's not the case here. These guys will keep it going. The payout ratio is safe, 58%. They have a 27-year dividend growth streak. The price is affordable. It's a little under $67 a share. You can see they are in the March, June, September, and December timeframe of paying a dividend. So it's about $1.87 per share annually. It comes to about 47 cents per quarter. And the total return for the last 5 years is about 78%. It's pretty good. You're typically not going to see uber high returns with utilities. You're going to see a steady return and a consistent dividend payment. This is a very, very decent, superb return for a utility. All right, so where does that leave us? Well, you can see how they all stack up. Okay. Now, listen, I did say that I did not make a selection for communication services. The one investment I did not select was Verizon. I've owned Verizon. I actually sold it all. If you're looking for something for an investment in the communications market sector, I suppose you could just buy it and you'll get a dividend. But the reason why I sold it is I think that it could be a problem. They have a very high debt level and they just are not really growing. But I'm showing them there. You can look at it. You can make that decision for yourself. But you can see how these all stack up. As I mentioned, the March, June, September, and December months, we have most of the dividend payments. So, basically, I chose 18 stocks. All right. 10 of them are paying in the March, June, September, and December. So a little bit more than half. 5 of them in the February, April, July, and November. I think I got those months right. Yep. But you can see how they stack up. You can see the dollar amounts. Um, I did the sum for each month and I did an average. So basically, the sum is about $2.51 for your dividend payment. So if you own one share of JP Morgan Chase, one share of ADP, and one share of Realty Income, you're going to get a total dividend payment of $2.51 across all three. Of course, if you own more shares, you're going to get more. And what do we do? What do we do as dividend investors? We drip. We continuously drip. Always be dripping. You want to grow those holdings. You can see what the average is, and it's just the average of the three. It's 84 cents. You can see that the numbers do go up in February, and then in March they go way, way up. And then the cycle repeats itself. The total average yield, I'm going further to the right, comes to about 2.86%. That's as it is right now. Now, keep in mind that if you go ahead and buy and drip and drip and drip, your yield on cost is going to go way, way up. And that would be a very good thing. And it'll go up because you have a growing dividend. Look at the average 5-year CAGR, just an eyelash below 12%. That'll drive your yield on cost up. Your average payout ratio for these stocks is a little under 45%, not bad. Your average dividend growth streak for all 18 of these is 20 years, not too bad. And folks, that is it. I do hope you found this to be informative and enjoyable. And I would kindly ask you to give us a like and subscribe to our channel here at Dividend Blasters and share the video with a friend. I'm also on Twitter, so feel free to connect with me on Twitter at Dividend Blast 99, or I guess we're now calling it X. So go to X and follow me at Dividend Blast 99. I'm on Instagram at Dividend Blasters. So love to connect with all of my listeners. And in addition to sharing, please hit that notification bell so you'll be notified each and every time we release a new video. Until our next video, have a wonderful day. God bless.